The only way you stop the rates go up with hikes or rates go up with cuts is you devalue the heck out of the currency and you basically buy down the debt. And provisionally, we've talked about this before, it's on the books. They could do it with gold. It ain't going to happen at gold 4,000. It ain't going to happen with gold 8,000. Gold 20,000 is probably the opening bid to have a real effect with that. So point being is I think people are seeing the symptoms, right? Your friend saying, oh, rates went up when they cut rates. I don't get it. That's the girl washing up on the beach at the beginning of the movie in Jaws, right? Oh, it's just a boating accident.
The global financial system is slipping deeper into fiscal dominance, where rising debt, structural deficits, and unstable rate dynamics leave policymakers with fewer viable options. Rate hikes now increase deficits, and rate cuts risk igniting more inflation, creating a feedback loop where currency debasement becomes the only functional release valve. Early signs of this pressure are emerging across real estate, consumer spending, and long-duration assets, signaling the early stages of a much larger structural adjustment. Luke Gromen, a leading macro strategist known for his work on sovereign debt sustainability, explains that these pressures make a significant currency devaluation both inevitable and intentional. In his view, gold reaching $20,000 is not a speculative target, but a requirement for absorbing unsustainable federal liabilities and buying down the debt through revaluation. Sovereign wealth funds, commodity exporters, and surplus-running nations already understand this shift and continue to accumulate gold as their preferred reserve asset. Meanwhile, private Western investors, still anchored to outdated policy assumptions, struggle to recognize that persistent debasement is now the dominant trend shaping the next decade. As inflation becomes policy and liquidity cycles tighten, gold's asymmetric upside expands dramatically. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
In summer of 2022, if you remember back, and I'm sure we talked then, the consensus on Wall Street was Powell's going to be Volcker, right? Inflation's out of control, but he's going to be Volcker. He's going to take pain. And we wrote in summer of 2022, he ain't going to be Volcker. It's not even a choice for him to be Volcker because of the debt and the deficit situation. Apples and oranges compared to Volcker. He has a choice of being Benjamin Strong, who led the U.S. into the Great Depression, or he can be Arthur Burns, who leads the U.S. into the 70s. Those are his choices.
Yeah.
Those are if he's lucky. Those are the good outcomes for him. And so we assumed it wasn't going to be Benjamin Strong. And so, probably some version of Burns. And we're sort of seeing symptoms of that. But the point in saying that comparison was when you're in fiscal dominance, when debt to GDP is as high as is, you raise rates, you raise deficits, and deficits are stimulative. Oops. If you cut rates, well, especially once inflation's a little elevated, to lower deficits, to cut interest rates, to lower deficits, which is in theory, lower deficits should be non-stimulative or contractionary, you're stimulating by cutting rates. So he has a choice of how he wants to inflate, how he wants to be Arthur Burns. And that's what we said at the time. And it's starting to play out. And what your anecdote suggests is the real estate community doesn't understand that yet, but they're gonna soon, which is how do they want rates to go up? Do they want rates to go up with inflation going up, or do they want rates to go up with inflation going down? Because either way, they'll go up if he cuts rates and inflation picks up, and they'll go up if he raises rates because he's raising rates. And oh, by the way, that makes the debt less sustainable and therefore higher rate on a less sustainable debt. So there are still a lot of people, I don't think, that appreciate that outcome. I agree with you 100%. You said something before that people are finally kind of seeing the bigger picture, right? The fact that everyone and their mother in the mainstream media is now talking about the debasement trade, right? How you and I have been talking about this for what, 5 years, 7 years?
Yeah.
I feel like Bruce Willis, come on in, welcome to the party, pal. But it's not a debasement trade. It's a debasement trend. This ain't going to stop. And oh, by the way, the only way you stop the rates go up with hikes or rates go up with cuts is you devalue the heck out of the currency and you basically buy down the debt. And provisionally, we've talked about this before, it's on the books. They could do it with gold. It ain't going to happen at gold 4,000. It ain't going to happen with gold 8,000. Gold 20,000 is probably the opening bid to have a real effect with that. So point being is I think people are seeing the symptoms, right? Your friend saying, oh, rates went up when they cut rates. I don't get it. That's the girl washing up on the beach at the beginning of the movie in Jaws, right? Oh, it's just a boating accident. And then, next comes the poor little boy, and then they're going to catch a shark, right? And they're, 50-year mortgages, or Trump's going to tweet out the Walmart CEO thing. Well, Thanksgiving spending's down. And then they fact check them and they're like, well, there's 6 less items. There were 21 items on the menu last year. There's 15 this year, and they're almost all store brands versus brand names last year. But yeah, other than that, right? That's where they catch the shark, and everyone's like, hey, we got it, it's over. And the guy's like, the bite radius on that animal doesn't match the bite radius on the victims. That's not your shark, right? And then finally, we're going to see the shark. And when we finally see the shark, everyone in the real estate business is going to go, oh my God, if they cut rates, we're screwed. If they raise rates, we're screwed. Sell your house now as fast as you can. And, then what? I don't know. But people don't appreciate that they are painted in a corner yet. They know they need to debase, but they don't really get it's the Trump administration acting to maintain the real value of the bond market and not inflating, which is what the country needs, which is if strategically. So ultimately, if they're going to try to act to support the bond market by capping, that's austerity, right? So actually, that's not going to work. That's going to tighten liquidity, and Bitcoin's going to be the first thing that warns you of it. I think you're not seeing it with gold, in part because I think ultimately gold is being bid on the other side of this as the sovereigns are going, holy cow.
Mm-hmm. That's what it is, isn't it, Luke?
I think it's a timing thing, right? I know how this is going to end, right? If I'm managing a sovereign fund, A, I don't try to trade month to month, quarter to quarter, but B, I run a surplus. I have a choice. I can buy dollars or I can buy gold. That's it. Those are my choices. I think that choice is easy. I buy gold. I think it's most of the sort of private sector, particularly in the West, they don't have the luxury of taking a 40, 50% drawdown, the implied vol of Bitcoin, and gold simply really hasn't shown that kind of volatility. I think that's part of it. And part of it has been, Bitcoin in the short run has traded like a tech stock, right? And so its technicals look like a tech stock. And, think about, we're talking about tech. If AI breaks, Bitcoin's probably going to break. And I don't agree that Bitcoin should break with AI. I had been arguing that point up until very recently that no, they won't. There'll be a recognition. And recently I'm like, no. If AI and NVIDIA get shot, taken out back and shot, Bitcoin's going to get taken out back and shot too. And it's not the right thing to do, and it'll be an opportunity. I don't make the rules, right? So I think that's part of it. I'm excited we're finally moving towards industrialization again. I'm excited that we realize we have a grid problem. We've been talking about this for years and years.
Yeah.
People finally understand. And I'm excited to see new technologies like small modular reactors and discussions that, there might be one up and running in Ontario in 2027 or 2029. And in the last 10 years, the Chinese have put up electrical capacity equal to the entire United States grid in 10 years.
So insane.
And they're not standing still. And so when you look at things like that and you go, could gold go up above the dollar in the next crisis? Yeah, absolutely it could.
Rising geopolitical tension, structural debt imbalances, and shifting global power dynamics are accelerating a broad repricing of financial risk. Proposals to use stablecoins as a new channel for dollar demand reveal a deeper attempt to mobilize bank reserves, stimulate liquidity, and slow the rise in interest costs. Yet the math behind multi-trillion-dollar stablecoin growth clashes sharply with real adoption patterns, exposing a widening gap between policy intentions and market realities. Meanwhile, global trust in U.S. financial safety has eroded since foreign reserves were frozen in 2022, pushing sovereigns toward gold as a politically neutral asset. This shift is reinforced by rapid technological changes in warfare, supply chain vulnerabilities, and the geopolitical leverage embedded in rare earth production. As naval dominance loses its historical advantage and critical materials become strategic choke points, the underpinning of the dollar weakens. In this environment, gold increasingly outperforms as liquidity tightens and confidence realigns. Now, let's get back to the interview.
Stephen Miron, Fed governor, came out with a white paper discussing what he called the opportunity to use stablecoins, basically create a global stablecoin glut, which is something we've talked about before. Not in those terms, but that basically, hey, Besant has said there could be up to $3 trillion in stable coins. And the thought is, you know what, foreigners would rather hold a dollar than their own currency. And so they can own it in stable coins on their phone, and that'll be backed by T-bills. And this will create trillions of dollars of T-bill demand. It's essentially a repressible balance sheet. And what Myron's white paper talked about was this global stablecoin glut, is what he phrased it, saying it could be like what Ben Bernanke called the global savings glut from 1996 to 2004. So by way of background, Bernanke did a white paper in '05 talking about the global savings glut. He was trying to explain why interest rates in the U.S., in particular the West more broadly, remained persistently low despite growth, et cetera. And he reasoned out that there was this global savings glut. And so Myron's paper comes out and says, well, if we do this stablecoin thing, we could get $1 to $3 trillion in stablecoins, and that would lower interest rates. It would pull flows out of foreign currencies into the dollar and strengthen the dollar, and it would widen our current account deficit in the same way that the savings glut, right? So the current account deficit is basically we import more stuff and foreigners put more money in our markets, right? So the current account deficit, the stuff we bring in gets bigger, and then the capital account surplus, what the foreigners invest in our markets, get bigger. What confused the heck out of me about this report is that, number one, Myron wrote a white paper very widely quoted last year called Restructuring the Global Trading System, in which he called for essentially the exact opposite on all those things. Weaker dollar, lower current account deficit, right? We make more stuff and send it to the world, and then reducing foreign capital flows in here to weaken the dollar. And now, so he puts out this white paper and highlights that. That left me very confused, number one. The second thing was that the stablecoin market cap for this $3 trillion number, like, I don't know where they're going to get it. Maybe they're going to do bank reserves all at once, but like, it's $300 billion. And it was $260 billion when they passed the Genius Act almost 5 months ago. So that's like a $10 billion a month growth rate, right? So if Bessa wants to get to $3 trillion by 2028, like, he better get going. And then if you look at it back even further to the past peak in stablecoin market cap, and the last, call it crypto peak, it was like $190 billion in early 2022. That's like a $5 billion per month growth rate in stablecoins, compounded annually. So like at that rate, it would take us like 60 years to get to $3 trillion. Maybe it's forced demand by banks, maybe like, to me, it's unclear to me how they can get to those numbers without Bitcoin being a much bigger number, unless they come out and say, look, there's $3 trillion in bank reserves and we're going to convert them all into stable coins like now. That could work, and that opens up some inflationary implications, and maybe that's what happens. I don't know. I look at this white paper as it relates to stable coins and the goals expressed for the stable coins, and they're running diametrically opposite of the goals of the administration and of Myron himself literally 12 months ago. And I come to two possible conclusions, neither of which I hold a strong opinion on either way. They're either throwing stuff against a wall and hoping it sticks, or they're saying one thing and they're just kind of doing what they need to do to keep the bond market happy, to keep Wall Street happy. And that, oh, by the way, is 180 degrees of what they promised they would do. They are acting in Wall Street's interest, not Main Street. But it's one of these things where, like, I don't know what it means, but I know it doesn't fit. And we'll know soon enough, right? Because there might be this sort of, I guess my other point is, they might be something really important they're leaving out, right? Like, oh, we're going to convert $3 trillion of bank reserves immediately into stable coins. And be like, oh, now that makes sense. And the dollar's going to get waylaid and inflation's going to pick up. And, because you're basically mobilizing sterilized reserves.
Yeah.
That would make sense. Growth would pick up. But again, then you go right back to the discussion we started with, which is if inflation picks up and monetary supply growth picks up, and it's not that monetary supply would change. It's that the velocity of those reserves will rise markedly. Yeah. So the effective supply would increase. The part that a lot of people on Wall Street are leaving out about gold and the rally, I can say it. I'm Cleveland. I'm not the establishment guy and whatever. They can't say it yet. They'll say it in another 2 or 3 years. But here's what they're going to say. 2022, U.S. government, by sanctioning Russian FX reserves, told the whole world, take your money elsewhere. Treasuries are no longer a safe haven. Then, 22 to 2024, the Russians told the world, that U.S. military. And in 2025, the Houthis, a little bit of the same in terms of technological change, right? And I would encourage everybody to read Eric Prince, former head of Blackwater, his speech from February. It's on YouTube about what the Houthis and the Russians were doing then, the technology change. The exponential changes that our friend Jeff Booth talks about came to the military. And now you got Houthis in the Red Sea, making aircraft carriers have to evade so hard that F-18s are falling off the damn ship. That wasn't an accident. And then you have the Chinese make it very clear that the United States can't go to war, full stop, without Chinese rare earths. Yeah. And the last people to admit this is true, these three things are true, are Wall Street. They're the last ones to get it. This is blasphemy. A, treasuries are no longer as safe as gold after 2022 sanctions. B, the Russians outproduced NATO and the Russians beat NATO. C, technology shift has ended 400 years of Mahan Doctrine, right? You control naval checkpoints, you control the world. Naval checkpoints now are death traps. Like, you had the Houthis making aircraft carriers of the United States dance so hard that F-18s are falling off the deck. What do you think the Russians are going to do? What do you think their underwater, unmanned, whatever the heck those things are? Do you want to be on a ship that's going through a narrow area like the Red Sea with those things out swimming? I wouldn't want to. And so checkpoints like that reverses the relative power dynamic, which, again, I'm not anti-American. I am simply telling people how it is and what that implies for the macro situation, which is the military backs the dollar.
You're pro-reality.
I am pro-reality. And then the final part is like, we can't make missiles fast enough if the Chinese send us the rare earths. And the Chinese are not sending us the rare earths. And there's like, it's a fascinating study in cognitive dissonance. You can see with our Treasury Secretary. He was this week. We think the deal's going to be done with magnets by Thanksgiving. Wait. You said the deal was done a month ago. And then it was done 2 months before that and done 3 months before that. And there's like, I like to try to keep things simple. I know I talk a lot, but I try to keep things simple. Look at it this way. Besant and Trump, etc., are making the case that the Chinese are going to willingly sell us rare earths that we are telling them we are going to use to make weapons to point at them. If your neighbor said he wanted to kill you and then also said, hey, can I borrow your shotgun? Would you give it to him? And if you did, you deserve to get shot. You're an idiot. And the Chinese are the neighbor. So like the rare earths aren't coming. They're not coming.
Yeah.
And so we're in this window of opportunity of like, to tie it back to your question, I think gold will beat the dollar. I think the dollar will go up, but I think gold's going to go up in dollar terms in liquidity.
Yeah. Growing geopolitical stress and accelerating structural cracks in the global system are forcing a reassessment of what truly qualifies as a safe asset. The push to build a massive stablecoin infrastructure illustrates how desperately policymakers are seeking new channels to absorb treasury supply and artificially support demand for the dollar, but the underlying contradictions are becoming impossible to ignore. The math behind multi-trillion stablecoin issuance doesn't align with actual adoption trends, and the assumptions ignore the inflationary surge that would follow any large-scale conversion of excess reserves into circulating digital dollars. At the same time, sovereign wealth funds and surplus nations increasingly recognize that U.S. sanctions have weakened the credibility of treasuries, erasing the perception of long-term safety. The military dimension adds a second structural break. Modern drone warfare, rare earth dependencies, and new naval vulnerabilities have reshaped global power dynamics, undermining the system that has supported the dollar for decades. With supply chain fragility rising and strategic resources shifting away from U.S. control, gold stands out as the asset least exposed to political pressure, industrial choke points, or financial repression. This realignment is not speculative. It's already visible in sovereign accumulation, commodity flows, and capital migration. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.